Welcome to the Deep Dive. I'm glad you could join us today. So, representing Optivest Investing Sri Lanka, we're going to tear down one of the most common and honestly one of the most dangerous assumptions in the investing world.
Yeah, it's this deeply ingrained narrative, especially among retail investors in the Colombo market, that a massive asset base just automatically equals a safe and highly profitable investment.
Right. People see a towering corporate headquarters or, massive land holdings, and they subconsciously equate physical size with financial stability.
Exactly. It's like we treat corporate structures the way we look at suspension bridges. We just assume that heavy, visible assets guarantee load-bearing strength.
But our mission today as forensic analysts is to dismantle that illusion. We're going to show you why management's capital allocation is the true engine of value.
And why an oversized asset base can actually become an anchor that drags a company down.
To pull this off, we've got a really fantastic stack of sources today. We are looking at the investing frameworks of legends like Warren Buffett, Charlie Munger, and Philip Fisher.
Which gives us the theory. But then we are cross-referencing that theory with a very gritty, real-world natural experiment.
Yeah, we have a stack of recent annual reports from two massive players in the Sri Lankan poultry industry, Raha Farms and 3 Acre Farms.
So whether you are actively managing a portfolio, or you just want to understand why some massive legacy corporations fail while smaller ones thrive, this is going to change how you look at the phrase, assets under management.
Absolutely. But before we touch physical assets, I think we really need to look at how the financial industry incorrectly values papal assets.
Oh, for sure. The foundation of this whole illusion really begins on Wall Street. It's the structural dysfunction of how capital managers are compensated.
Right. They get paid for just gathering assets rather than actually managing them well.
Exactly. The industry is heavily incentivized to just hoard capital.
The sources have this incredible anecdote about Warren Buffett and his 2 primary investment managers, Todd Combs and Ted Weschler.
It's a perfect example of the math getting, frankly, ridiculous.
Right. So Buffett pointed out that Todd and Ted each started with about $5 billion to manage.
And if you apply that standard Wall Street 2% flat management fee to $5 billion.
It's the equivalent of giving someone a multi-million-dollar tip just for parking your car, even if they crash into a wall.
Because if Todd and Ted took that $5 billion and literally just stuffed it under a mattress, doing zero analytical work, that 2% flat fee means they'd each walk away with $100 million a year.
Just for holding the money. But here is the index fund shocker.
Right, the Vanguard example.
Yeah, if they exerted the absolute minimum amount of effort imaginable and just put that entire $5 billion into a basic S&P 500 Vanguard index fund.
Which takes about 5 minutes on a smartphone.
Exactly. Capturing the market drift and that flat fee over a few years, standard Wall Street rules would pay them over $300 million each.
$300 million for a trade that you or I could execute while waiting in line for coffee.
It perfectly isolates the whole asset gathering trap. A manager can deliver completely subpar returns, but if they've gathered a large enough pile of assets, they still collect a fortune.
And I think we need to look at the macroeconomic cost of this. Because it's not just a quirk of rich people paying other rich people.
Right, it's a real drain on the productive economy. Let's do the math on Berkshire Hathaway itself.
Okay, so Berkshire has roughly a $200 billion portfolio. If they paid that standard 2% fee, they would be burning $4 billion a year.
$4 billion just on management tolls, which is staggering when you compare it to what Berkshire actually builds.
Yeah, they deploy roughly $11 billion annually into vital physical infrastructure.
Like the BNSF Railway, which moves more freight than any other carrier in the U.S., or Mid-American Energy, which is building renewable wind and solar grids.
So if they were trapped in that asset-gathering fee structure, 73% of their productive capital expenditure would just vanish.
The literal money meant to lay down railroad tracks would be wiped out to pay bankers.
Jeremy Grantham is quoted in the sources capturing this perfectly. He said that raising fees raids the balance sheet.
Raids the balance sheet. I love that phrasing.
It intercepts capital that should have been deployed into the real economy and converts it into bankers' bonuses. It starves the productive engine.
It's a visceral image, and it shows exactly how Wall Street manipulates paper assets. But That same psychological bias applies directly to physical businesses on Main Street.
Oh, absolutely. Retail investors frequently look at a company's book value, the massive tracts of land, the heavy machinery,
And they think, well, there's my margin of safety. They own so much physical stuff, they're too big to fail.
but they are mistaking the presence of assets for the efficiency of operations.
Which is where we need to introduce a metric called return on assets, or ROA.
Right. ROA measures the actual profit generated relative to the total assets employed.
It forces you to realize that having a state-of-the-art commercial kitchen doesn't matter if you are burning the food.
That's a great analogy. The kitchen with the imported Italian ovens is just the asset. The chef is the management.
And that leads us to the management engine framework from investors like Philip Fisher and Charlie Munger.
Because assets don't think. A factory doesn't strategize against inflation. Land doesn't negotiate supply chain bottlenecks.
Assets only represent potential value. You can have two companies with the exact same identical asset bases, and they will produce completely different financial results.
Because the decision-making engine sitting on top of those assets dictates the actual outcome.
So I want to take this out of the realm of theory. Let's see this management engine tested under extreme pressure.
And the sources provide a flawless natural experiment for this with the Sri Lankan poultry sector.
It's the ultimate testing ground because
Right.
we have two publicly listed heavyweight companies operating in the exact same industry.
Selling the same core product and facing the exact same macroeconomic gauntlet over the last couple of years.
Let's introduce the contenders. First, we have Bairaha Farms.
The legacy pioneers.
Yeah, they've been around since 1975. And in 1986, they created the local contract growing scheme.
For the listener, contract growing means Baraha distributes chicks and feed to a massive network of independent farmers to raise and then buys them back.
Right, so it's a highly complex, decentralized operation. Plus, they are sitting on a massive, tangible 309-acre land bank with fully vertically integrated processing.
They are the textbook definition of an asset-heavy legacy corporation.
And then we have 3-acre farms, another titan, with a 60-year history, part of the Prima Group.
They also boast an enormous fixed asset base, huge hatcheries and highly advanced environmentally controlled or EC houses.
Just to clarify, these EC houses are basically giant, high-tech, biosecure, climate-controlled domes.
Right, they protect the birds, but they require an absolute fortune in electricity and upfront capital to run.
So both companies enter the 22-23 period armed with incredible physical assets, but the Sri Lankan market went through an absolute economic gauntlet.
It was brutal. You had the post-COVID global supply chain nightmare.
Plus crippling domestic inflation driving up the cost of feed, energy, and labor.
And to fight that inflation, the central bank hiked interest rates aggressively, making borrowing incredibly toxic.
And if that wasn't enough, there was a massive biological shock. A severe bird flu outbreak in the United States.
Which disrupted the global supply of grandparent chicks.
Grandparent chicks are the top of the supply chain pyramid, right?
Exactly. They breed the parent birds, which breed the commercial broilers. When that supply was choked off, it tested the management engine of every poultry company on Earth.
So we have identical macro shocks, identical supply chain crises, identical biological threats. Let's look at whose return on assets actually holds up.
Let's start with Bairaha's execution. On paper, if you just look at asset gathering, they look like they were booming.
Yeah, their annual reports show their total assets grew by 37%, ballooning to over 8.5 billion rupees.
But underneath that growth, their capital structure was imploding.
To fund that expansion, their borrowings rocketed up 274%.
They took on a staggering debt burden exactly when the central bank was driving interest rates to their peak.
And this is where the operational execution, the chef in our kitchen analogy, completely broke down.
Right. When the bird flu crisis hit and feed costs were spiking, Baira's management panicked.
They adopted a highly reactionary approach. They engaged in the early culling of their breeding stock to minimize short-term feed expenses.
They basically liquidated their biological assets to save cash in the short term, which created a devastating bullwhip effect.
Because by culling early, Bairaha suffered severe undercapacity when consumer demand eventually began to recover.
Exactly. Their massive, expensive processing plants were suddenly starved of product.
And because they had killed off their breeding stock, they were forced to scramble and import parent chicks at a massive premium just to get the lines moving again.
That is the literal definition of misallocating resources. You take on massive debt to expand your physical footprint, but you destroy the biological engine that generates the revenue.
And from the sources, they got squeezed on the pricing side, too.
A brutal double impact. The government introduced increased taxation through the Social Security contribution levy and higher VAT.
Normally, a dominant company just passes those costs to the consumer.
But Bayratha couldn't because of intense competition from informal gray market operators, smaller, unregistered farms, flooding the market with cheaper, untaxed meat.
So they had zero pricing power. They have massive new debt, sky-high interest payments, premium import costs, and they can't raise prices.
The math is horrifying. Their net profit margins plummeted to roughly 0.9%.
And their return on assets collapsed to an abysmal 1.3%. They had 8.5 billion rupees in assets, and they were barely scraping a 1% return.
Their massive asset base didn't protect them. It became a constraint. It required massive working capital to maintain, which forced them into expensive debt.
Now, contrast that with 3-acre farms sitting right across the street in the exact same economy.
While Bayratha was taking on that massive debt load, 3-acre farms management went in a completely opposite direction.
They maintained a zero-debt position, which is wild in that environment.
Total capital discipline. They recognized that in a hyperinflationary environment, how a company funds its assets is just as critical as the assets themselves.
So instead of relying on desperate bank loans, they utilized the excess cash generated from their highly efficient operations.
And even more impressively, they took their surplus funds and deployed them into midterm bank deposits.
That is just an incredible pivot. While Bayratha is bleeding cash to pay interest to the banks, 3-acre farms is collecting high interest from the banks.
They turned a hostile macroeconomic environment into a revenue stream.
But what about the operational side? How did they survive the bird flu and the feed inflation without panic culling?
They prioritized long-term capacity management over short-term panic. They absorbed the temporary pain of high feed costs and continued their production and import cycles.
They kept their biological assets intact.
So when the market stabilized and demand returned, 3-acre farms had the inventory ready to capture the market share that Bayratha was too depleted to serve.
And the financial results are staggering. Bayratha was dealing with massive losses, but 3-acre reported an explosive 263% increase in operating profit.
Crossing 2.2 billion rupees. Their earnings per share jumped 280%.
Same country, same crisis. Completely different outcomes because of the management engine.
It forces a total reframing of how we analyze companies. The market doesn't reward the size of the assets. It rewards the effectiveness of the decisions made on those assets.
Which connects perfectly back to a brilliant piece of investing philosophy from the Warren Buffett source material regarding Newton's fourth law of motion.
This is such a great anecdote. Sir Isaac Newton, one of the smartest human beings ever, actually lost a massive personal fortune speculating in the South Sea bubble.
It's a permanent reminder that raw mathematical genius does not automatically translate to rational capital allocation.
Right. And Buffett joked that the trauma of losing all that money should have led Newton to discover a fourth law of motion for the financial world.
And that law is, for investors as a whole, returns decrease as motion increases.
Returns decrease as motion increases. It is a profound insight into corporate behavior.
Think about Bayratha's strategy during the crisis, growing their physical asset base by 37%, taking on massive new debt tranches, scrambling to import premium chicks.
That is all motion. It feels like aggressive corporate progress because you are busy, you are buying things, your balance sheet is getting larger.
But it is motion without traction. You are revving the engine while the transmission is in neutral, and the friction is just burning up the car.
Exactly. All that frantic motion actually destroyed their returns because it wasn't efficient. True progress isn't asset accumulation. It is asset efficiency.
It's the ability to squeeze maximum cash flow out of the infrastructure you already control.
And the annual reports prove that 3-acre farms is hyper-focused on this. They boast an impressive 60% asset turnover ratio.
Meaning, for every single dollar of assets tied up in those massive EC houses, they are generating 60 cents in revenue. They're making those assets sweat.
And because they were so disciplined with their capital, they grew their net assets per share by 9% in 2024 entirely organically.
They demonstrated that their management engine is focused on extracting value from their existing footprint rather than just engaging in the motion of taking on toxic debt to look bigger.
Right. Let's bring this all together for you. The next time you are evaluating a company, you have to actively fight the urge to be dazzled by the sheer scale of what they own.
Yeah, massive land banks, towering corporate offices, those are all just potential energy.
They are the kitchen, not the chef.
Exactly. You can't control the macroeconomic storm, but you can control whether you are navigating it in a highly maneuverable speedboat or a massive bloated cargo ship that takes 10 miles just to turn around.
If the management engine is taking on bad debt, panic selling core inventory, and engaging in frantic motion just to maintain a facade of growth, those massive assets aren't a margin of safety.
They are an anchor that will drag the entire operation to the bottom when the economic weather gets rough.
The evidence across both investor frameworks and real-world case studies leads to one unavoidable conclusion. Asset ownership alone does not create value. Efficiency, discipline, and adaptability drive returns.
And I want to leave you with a final thought drawn from a 2007 commencement speech given by Charlie Munger at USC Law School.
He spoke extensively about the dangers of self-serving bias. It's the subconscious human tendency to rationalize that whatever personally enriches us must also be the optimal way to run the system.
He warned that if you don't account for that bias in the people managing your capital, you are a fool.
Right, so look at the entire ecosystem we just unpacked. Think about the Wall Street hedge fund managers collecting hundreds of millions of dollars just for parking money in an index fund.
Entirely protected by the sheer size of the assets they gathered.
Or think about corporate executives whose annual bonuses and industry prestige are entirely tied to expanding the sheer size of the empire they oversee, rather than the unglamorous work of improving return on assets.
So ponder this. How much of the bigger is better narrative that dominates the corporate world is just an illusion?
An illusion driven by an industry actively trying to justify higher management fees and larger executive bonuses, rather than a genuine desire to allocate resources efficiently.
Are they building the bridge to actually connect two cities and facilitate trade? Or are they just building the biggest bridge possible so they can charge a premium toll for looking at the steel?
That is absolutely something to chew on.
Thank you so much for joining us on this deep dive. As analysts at Optivest Investing Sri Lanka, we encourage you to evaluate companies not just by what they own, but by how consistently they generate returns from those resources. Keep questioning the obvious, look past the size of the balance sheet, and stay tuned for further analysis on more investing principles and case studies. We will catch you next time.